CarMax just confirmed what we have all been fearing. The used car market is collapsing faster than anyone imagined. In a single brutal day, CarMax lost 47% of its value, wiping out $3.2 billion from the company that once called the shots. The CEO admits even he cannot predict what is coming next. Right now, that $26,000 Accord means a $668 monthly payment if your credit is less than perfect, at a staggering 22.95% interest. That is not just inflation. That is financial quicksand, and it is trapping everyday buyers overnight. With prices falling and loan losses exploding, the only question left is how deep this market crash really goes, and what kind of deals might be waiting at the bottom. CarMax just confirmed what we have all been fearing. The numbers coming out of Richmond are staggering. CarMax lost 47% of its value in a single day, erasing $3.2 billion from the books. This isn't just a bad quarter, it's a financial earthquake. CEO Bill Nash stood in front of analysts and said flat out, he has no idea what's coming next. That's not a press release. That's a white flag from the top. Here's the thing. When the biggest used car retailer in America admits it can't see the road ahead, every dealer, every lender, and every customer gets nervous. The market didn't wait for answers. Carvana shares dropped 12% the same day. Vroom fell 18%. Even giants like AutoNation lost ground. This is a chain reaction. One company trips, and the whole sector stumbles. CarMax built its empire on data. They were supposed to have the smartest pricing model, the best analytics, the most accurate forecasts. But their own numbers just broke the system. That's what makes this so alarming. If the company with all the tools can't predict what's next, who can? The pain goes way beyond Wall Street. CarMax moves over 1 million vehicles a year. They've got 240 stores across 41 states. When their value drops by almost half overnight, it's not just shareholders who lose sleep. It's every person with a car loan, every dealer with too much inventory, every buyer hoping for a deal. Nash didn't sugarcoat the pressure. He blamed tariffs on new vehicles for pushing more buyers into the used market. That sounds good for business, but it's a trap. Artificial demand drove prices up, and now buyers can't keep up with the payments. Margins are squeezed from both sides. Raise prices, and you lose buyers. Cut prices, and you bleed profit. There's no safe move left. The numbers tell the story. In 2024, auto loan defaults topped 2.3 million. Repossessions hit 1.73 million, the highest since the Great Recession. Lenders are tightening up. Dealers are sitting on cars they can't sell, or dumping them at a loss just to free up cash. CarMax's own data shows dealer-to-CarMax sales up 38%. Dealers are desperate for liquidity, and CarMax is the buyer of last resort. This isn't just about stock prices or balance sheets. This is about the ground shifting under the entire used car market. When the biggest player can't call the next play, it's open season on pricing, on lending, on who gets to stay in business. The old rules don't work anymore, and nobody knows where the bottom is. Here's the problem with buying a used car right now. The numbers don't add up for the average guy looking for a decent deal. Take a $26,000 sedan. Nothing fancy, just a practical car for getting to work and hauling the kids. At CarMax, the interest rate for someone with challenged credit is sitting at 22.95%. That's not a typo. 23% on a car that's already lost a third of its value the moment you drive it off the lot. And that boils down to a $668 monthly payment. For most middle-aged buyers, that's a mortgage-sized bill for a basic ride. It's not just the sticker shock. That payment stretches out over 6 years or more, and by the time you're finished, you've paid nearly double what the car was worth new. The bank gets its money either way, but the buyer is left underwater almost from day one. If you need a car to keep your job, you're stuck signing paperwork that locks you into years of payments you can barely afford. miss a couple of those payments, and the repo man's knocking. That's how 1.73 million cars got taken back last year alone, the highest number since 2009. CarMax isn't the only place with rates like this, but they're the biggest, and their approval process is designed for people who can't get a loan anywhere else. Folks with good credit have already left the building. What's left are buyers with no other options, desperate enough to sign whatever's put in front of them. The company's own data shows that most of their customers fall into this exact category, people with nowhere else to turn. And when the average rate is this high, it's not just a tough market, it's a trapdoor. The math gets uglier if you look at the real cost. Over a 6-year loan at 22.95%, you'll pay over $48,000 for that $26,000 car. That's before you even count insurance, maintenance, or the cost of rolling negative equity from your last vehicle into the new loan. It's a cycle that keeps people chained to payments, never able to get ahead. Dealers know it, lenders know it, and CarMax has built an entire business on it. For buyers, there's no easy way out. Trade in the car, and you're likely to owe more than it's worth. Try to refinance, and you'll get laughed out of the bank if your credit's taken any hits. The only thing that's changed is how fast the numbers are piling up. With defaults and repossessions rising, the next wave isn't just coming, it's already here. And for the average guy signing a car loan today, the odds are stacked higher than ever. CarMax's finance chiefs didn't waste time. In the first quarter of 2026, they set aside $101.7 million for loan losses, up from $81.2 million the year before. That's a 25% jump. For a company that prides itself on risk models and predictive analytics, this isn't a rounding error, it's a red flag. They're bracing for a wave of customers who can't keep up with payments, and the numbers don't lie. The reserve now stands at 2.76% of their total auto loans, up from 2.61% just 3 months earlier. That may sound like a minor tweak, but on a loan book this size, it's tens of millions of dollars set aside for one thing: people walking away from their cars. Executive Vice President John Daniels spelled it out on the earnings call. Losses are rising, especially on loans written in 2022 and 2023. Those loans, made when used car prices were sky high and credit was easy, are now coming back to bite. Borrowers are missing payments, vehicles are getting repossessed, and CarMax is eating the difference between what's owed and what the cars are worth at auction. To manage the fallout, CarMax started moving risk off its own books. This spring, they bundled up $637.9 million worth of non-prime loans and sold them to outside investors. That freed up $26 million from their loss allowance, giving them a little breathing room. But it's a sign of how quickly the ground is shifting. When a retailer starts offloading its riskiest loans, it means the company isn't just worried about a few bad months. It's preparing for a long haul of defaults and write-offs. Even the mix of buyers is changing. More prime customers are paying cash or bringing their own financing, leaving CarMax's in-house loan arm to handle the riskiest deals. Penetration fell to 41.8% from 43.3% last year, which the company says is because higher credit buyers rushed in after the tariff news broke. But the reality is simple: the easy money is gone. What's left are buyers on the edge, and CarMax is padding its war chest for the wave of missed payments that's already rolling in. Every quarter, the reserve creeps higher. Every quarter, the warning gets louder. Dealers are unloading cars at a pace nobody saw coming. CarMax's latest numbers show they bought 48,000 vehicles from dealers last quarter, a 38.4% jump over the same time last year. That's not just a blip. In fact, it's the third straight quarter with double-digit increases in dealer-to-CarMax sales. The quarter before, the spike was over 46%. Go back one more, and the number more than doubled. This isn't about CarMax changing its strategy. It's about dealers running out of options. Here's how it works. Most dealers make their real money by selling cars direct to customers. Wholesale is always a last resort because the margins are razor thin. But right now, a growing number of dealers are skipping the wait and dumping inventory straight to CarMax. Why? Cash. Floor plan interest is eating them alive. Every day, a car sits unsold. That's more money owed to the bank. With retail buyers drying up and auctions getting more expensive, selling to CarMax for fast cash starts to look like the only way to keep the lights on. There's another layer. Auction fees have shot up by about 50% since 2019, and shipping costs are up a third. Add in surprise repair bills after the sale, and a lot of dealers just want out. CarMax offers a check on the spot. No waiting, no haggling, no drama. That's why dealer-sourced inventory has doubled in a year, even as consumer sales barely budged. The company's own breakdown shows consumer purchases up just 3.3% compared to last year, while dealer sales exploded. Dealers know they're taking a loss, but for many, it's survival mode. They need to pay off their floor plans and keep their lenders happy. The alternative is falling behind on payments and risking a credit freeze. That's the real story behind the 38% spike. It's not about opportunity, it's about desperation. The old playbook, hold out for a retail buyer, make your margin, and move on, doesn't work when the market's flooded and buyers are tapped out. For a lot of smaller dealers, selling to CarMax is the only way to get through the month without defaulting on their loans. This isn't just a few unlucky dealers. The numbers show a wave of inventory hitting CarMax from all directions. The company is opening new stores and reconditioning centers, betting that the dealer distress isn't going away anytime soon. The more cars they buy from struggling dealers, the more leverage they have in the market. Meanwhile, every car sold wholesale is a sign that another dealer couldn't make the math work. That's the domino effect in action. One dealer after another, offloading inventory to stay afloat, even if it means taking a hit on every deal. Almost a quarter of Americans trading in their vehicles right now are handing over keys to cars that are worth less than what they owe. 24% to be exact. That's not just a blip. It's a tidal wave of negative equity rolling through the market. The average person trading in is $6,838 underwater. That means if you walk into a dealership hoping to swap your ride, you're starting nearly $7,000 in the hole before you even talk numbers. For a lot of families, that's not just an inconvenience. It's a financial trap that's almost impossible to escape. Here's the reality. Every time someone rolls negative equity from their old car into a new loan, the hole gets deeper. Some buyers owe $10,000 or even $15,000 more than their car is worth. That's not rare anymore. It's becoming the new normal. And it's not just hitting people who bought luxury SUVs or electric cars at the peak. It's hitting anyone who financed at sky-high prices over the last couple years, especially with long loan terms and little money down. This is a nationwide problem. Edmunds tracked the numbers. By the middle of 2024, the average negative equity on a trade-in jumped to levels nobody had seen before. The share of buyers underwater on their loans is now the highest on record. For every 4 people walking into a dealership with a trade-in, 1 is already upside down. The rest are just hoping their car is worth enough to cover the balance. And the cycle keeps feeding itself. Dealers and lenders have gotten used to stacking old debt on top of new loans, stretching payments out to keep monthly bills manageable. But that just means more people are locked into cars they can't sell, can't trade, and can't afford to fix if something goes wrong. Miss a payment, and the repo man isn't far behind. Even if you keep up, you're still stuck making payments on a car that's losing value faster than you can pay it down. Banks are watching this tidal wave of negative equity build, and they're already reacting. Credit is tightening. Approval rates for challenged borrowers are dropping. Lenders know that every new loan with rolled-in negative equity is a ticking time bomb. If used car prices keep sliding, the gap between what people owe and what their cars are worth is only going to widen, For millions of Americans, the car in their driveway isn't an asset anymore. It's a liability, dragging their finances underwater. Banks aren't just watching from the sidelines, they're pulling the plug. By the end of 2024, lenders seized 1.73 million cars from borrowers who fell behind, the highest number since 2009. That's not just a blip, it's a full-scale freeze on credit for anyone who doesn't have spotless finances. Approval rates for challenged buyers have dropped off a cliff, and the message from the banks is loud and clear: risk isn't welcome anymore. Dealers who used to rely on easy floor plan financing are getting calls from their lenders asking for cash or collateral. Miss a payment, and your inventory isn't just at risk, it's gone. The repo man isn't just knocking on doors in rough neighborhoods, he's making the rounds at suburban driveways and dealership lots. When banks slam the brakes, the whole market skids. Cars pile up at auctions, prices spiral down, and dealers scramble to raise cash. For anyone hoping for a deal, this is what a market in free fall looks like. Credit drying up, repossessions flooding the system, and lenders tightening the screws on everyone left holding the bag. Here's where things get interesting for anyone with cash on hand. The banks are locking down credit, lenders are pulling back, and repossessions are flooding the market. But if you're not relying on a loan, you suddenly have leverage dealers haven't seen in years. With so many cars stacking up on lots and dealers desperate for liquidity, cash buyers can cut through the noise. It's not just about haggling. It's about walking in with the power to close a deal on the spot. No financing drama, no waiting for approvals. Now, tariffs on new vehicles have pushed the average new car price to $48,000. That's a mountain most families aren't willing or able to climb. Used cars are supposed to be the escape hatch, but even here, sticker prices are stubborn. Dealers who bought inventory at last year's highs are now underwater, and every day those cars sit unsold. The floor plan interest keeps piling up. For a cash buyer, that's an opening. You're not just another shopper. You're the solution to a dealer's cash crunch. And here's the kicker. With credit tight and repo rates at record highs, the market is splitting in two. On one side, buyers who need loans are getting squeezed out. On the other, anyone with cash or access to outside financing can negotiate on their terms. Dealers know it. They need to move metal, clear space, and stay afloat. For the first time in years, the real deals are going to the people who can pay up front. If you've got cash, you're in the driver's seat. CarMax just confirmed what we have all been fearing. In one day, its stock plunged 47%, erasing $3.2 billion in market value and sending shockwaves through the entire used car industry. Internal documents showed a 25% jump in loan loss reserves as management braced for a surge in defaults. Dealers scrambled, offloading 38% more inventory to CarMax, while nearly a quarter of trade-ins came in with an average of $6,838 in negative equity. Nationwide, 1.73 million vehicles were repossessed in 2024, and banks tightened lending standards even further. Today, tariffs have pushed the average new car price to $48,000, making deals scarce for buyers without cash. CarMax's CEO admits that what comes next is impossible to predict. The full impact on consumers and smaller dealers remains unclear, as critical financial data is still unreleased. What's certain is that the era of easy money in used cars is over for sellers, for buyers, and for CarMax itself.